Good morning. Good afternoon, everybody. I'm Jonathan White from Knowledge Bank. It's my absolute pleasure to be your host today. I get to do virtually none of the work, and our guest speaker does it all, which is absolutely fantastic. But we're really looking forward to the session that we've got this morning with CHL. A few things before we kick off. We do, as you know, regular participants in this these events, we do encourage questions throughout. We've already had some questions submitted, so my responsibility is to make sure that those get answered. We encourage interactive questioning during the presentation. Andy's happy to take those questions. We've already talked about that. CPD certificates will be issued to you following the event if you stay on till the end. And I just want to plug two things. One is, if you're not a Knowledge Bank user, we would encourage you to have a look. As a free 30-day trial, just go onto the website and register for a free 30-day trial. Lots of trialists at the moment, because we've got the 12 days of Christmas promotion as well, which you should probably have a look at. Just to remind you, 140,000 pieces of criteria, 250 lenders, and the first and most comprehensive criteria sourcing system in the UK. So that's a little plug for us. I'd love to welcome our speaker. It's Andy from CHL. It's Andy Valvona, or as he's known to his family, Valvona, because he's Italian. He told me to say that. So Andy's got a massive experience in the industry. Just looking at it before I came on, it really gives a broad view of the market. He's worked in distribution in terms of organizations like Mortgage Intelligence and Primus, so understands that side of distribution. Also in technology, worked for organizations like Synaptic Systems and SSP, so that really gives a good background as to technology and how it's used. But in the lender space, stints with BM Solutions, Nationwide, Co-op, Fleet, but also 3 current years, which are probably the most important, and that's with CHL. So Andy, welcome.
Thank you.
We're looking forward to hearing from you. We know that today is all about CHL. We know it's all about the new products that have been launched in, and also some changes, some pretty important changes to criteria. So look, Andy, I'm going to hand over to you. If you want to run your slide presentation, I'll look forward to taking any questions as and when they come in.
Okay.
To you.
Okay. Well, thanks for that introduction, Jonathan. And good afternoon, everybody. Thanks for joining this session. So what I'm going to do is talk to you about our product range expansion. So you may have seen on the slide that we're now operating with a CHL1 and CHL2. And don't worry, I'm going to explain what that's all about in the coming slides. So as Jonathan mentioned, my name's Andy Valvona. I've been in the buy-to-let market since it started. You might remember, some of you that is, might remember a lender called Verso, which was part of Britannia Building Society, and latterly the Co-op Bank. We were in the buy-to-let market pretty much after it started back in the mid-90s. So got a lot of experience in the buy-to-let market. And CHL Mortgages has also been around since that time as well in the buy-to-let market. So lots of experience in that particular arena. And I'll just move on to the next slide, which gives you an overview really of what I'm going to be talking about. Who are CHL? What are CHL1 and 2, as I mentioned? And then I'm going to go on to affordability, complex limited company structures, short-term lets, refurbishment products, amongst other things. So covering quite a wide range of topics. As I mentioned, CHL Mortgages has been around since the mid-90s in the buy-to-let market, and prior to that as a residential lender. What are we now? We've morphed into CHL Mortgages being a specialist buy-to-let lender. So that's the market we concentrate on, and we lend on complex cases in England and Wales. We relaunched as a lender a couple of years ago, having had some time out of lending. So many of you will have clients that have got an old CHL mortgage that they've been enjoying quite a reasonable rate on all these years. So in terms of CHL1 and CHL2, it's just been launched. You may have seen some press. Here's Mortgage Solutions from a few days ago, talking about CHL Mortgages unveiling our new ranges, CHL1 and CHL2. So what are they? Well, CHL1 is basically going to enable landlords with limited company, individuals, LLPs, with a clean credit history to benefit from lower rates. So that's the big distinction between CHL1 and CHL2. The rates are going to be lower on CHL1, and it's more straightforward. Complex buy-to-let is probably the best way I can put it. So we will lend on CHL1 on small HMOs and multi-unit blocks up to 6 bedrooms, 6 units, standard properties as well, of course. So that could be flats above commercial, studios, even to up 2 downs and 3-bed semis. So a wide range of properties right up to smaller HMOs and multi-units. I mentioned rates. Rates has been a big issue over the last year, and you're starting to see rates come down. Rates on the CHL1 range start at 3.72 on a 2-year fix. So it's an area where the more vanilla client can enjoy a better rate than on our CHL2 products. So what we'll do on CHL1 is up to £3 million of lending, a maximum of 20 properties for the same client. And CHL2, conversely, we can lend also to individuals, limited companies, LLPs, but also trading companies. Some minor adverse is acceptable on CHL2. Both small and large HMOs, multi-units, and hybrid properties are available on CHL2. Now, a hybrid property is a multi-unit block that has a mixture of non-HMO flats and HMO flats in it. You've probably come across those. So not all 2-bedroom flats in a block or all 1-bedroom flats. It might be a block that's got a 5-bed flat on the ground floor and 2-bedroom flats above. So that's quite a tricky type of product to place, but that falls squarely into what we can offer on our CHL2 product. We can also look at now at multi-unit blocks without separate services. We've always had a criteria that the properties within a multi-unit block have to have separate services. In other words, their own gas and electricity meters. We can now on CHL2 lend on properties without separate services on a case-by-case basis. And it like any mortgage lending, it does fall down to the valuer's comments. So if it's a nice block without separate services and it works, and there's a demand for that kind of property, then we'll lend. If it isn't, then the answer might be different. Short-term lets falls into CHL2, and I think Jonathan's got a question. No?
Sorry, I didn't know. I was going to try to be really awfully polite there. I've got a question from Andy Watterson. He says, hi, it's good to see you again. So presumably you know each other, which is really nice.
You too.
We've got a couple of properties. He's got a couple of properties for housing associations. What's the stance on housing associations?
Yeah, we basically we're quite happy to lend where the tenant is a housing association. We just need to see the tenancy agreement. So with all corporate letting agreements, council agreements, housing association agreements. We just need to see the agreement first. And basically, there's got to be a break clause in that letting agreement. So yes, we will, subject to. So either get in touch with your local BDM or me with that particular case. Let us have a look at the tenancy agreements before you go to application stage. To answer the question, Jonathan. I assume yes. Where was I? Yes, short-term lets, a refurbishment range of products on CHL2, which I'll go on to in just a moment. And the CHL2 allows for up to 5 million of lending with no maximum number of properties. So remember, it was a lower amount with a definitive number of properties on CHL1. There is a maximum of 2.5 million in the first 12 months. But up to 5 million on CHL2. And of course, with CHL2, we have a flexible level of criteria. So use Knowledge Bank's Notify. If you've got a case that you think may not fit squarely, if it's a low loan to value, use Notify to get in touch with us or contact your BDM. Like many lenders, we can have a look at a deal that perhaps doesn't fit our standard criteria. So here's a quick comparison.
I don't know if you can hear me. I've got another question for you. Question from Gemma Fernandez about smaller HMOs. If these are done to a reasonably high spec, i.e. in ensuite bathrooms, in all rooms, example, is it bricks and mortar or hybrid or investment valuations? Which valuers do you use? I know you mentioned it.
So for small HMOs, our standard is Connell's on a comparable based valuation. For larger HMOs product, we are looking at allied surveyors on an investment basis. But we are able to take in a small HMO on the CHL2 range, which uses an investment valuation. So that is possible. Yes. Once again, talk to us on that particular deal.
Yeah.
So here's a quick comparison table which shows the difference between CHL1 and CHL2. So our standard buy-to-let, CHL1 is a standard buy-to-let, small HMOs and multi-units. And our CHL2 range covers also standard buy-to-let, small HMOs and multi-units, large HMOs and multi-units, short-term lets, and trading companies, Isle of Wight properties. So Isle of Wight properties are not available on the CHL1 range. Okay. The portfolio exposure, as I mentioned earlier, 20 loans max, up to 3 million on CHL1. In the first year, 2.5 million on CHL2, rising to 5. And there's also some adverse credit. That's a minor adverse is allowed on CHL2. So CHL1, no adverse credit in the last 3 years. CHL2, we are able to take up to £500 satisfied CCJs, for example, one secured arrears, one unsecured arrears, both in the last 12 months, and defaults are considered at discretion. We would normally also ignore communications defaults for CHL2. So there's a big difference between CHL and CHL2. So a standard buy-to-let property may go on CHL2 because of client's credit profile. So I think one of the things that has been very difficult for intermediaries this last 12 months is affordability on buy-to-let, whether that's on a purchase or on a remortgage. And some lenders have been able to help that with top slicing, for example. Tends to be for small numbers of buy-to-let portfolio, buy-to-let cases in the portfolio. We can apply what we call a blended ICR to a client that's got one property already, no properties already that they let out, or 400 properties that they let out. So this applies to portfolio landlords, and it's a blended ICR. Now, what does that mean? Well, I think you'll all be familiar that a higher rate taxpayer is stressed at a higher percentage than a lower rate taxpayer. So where you've got a joint application where one applicant is a higher rate taxpayer and one is a lower rate, typical example could be a married couple, then the higher stress rate would apply. Well, at CHL Mortgages, what we've been able to do is blend the ICR. So if we look at this example, let's say we've got, and the rates are historic, so don't worry about those. Let's say we have two people applying on a 5-year fixed rate of 5.53. Applicant one, basic rate taxpayer, so we would stress that at 125. Applicant two is a higher rate taxpayer, so we would stress them at 140. And the rental yield of the property, let's say it's £1,500. So without the blended ICR, we're going to stress at 140 to give the client a maximum level of borrowing of 232,498. But by blending the ICRs, in other words, on a 50-50 ownership basis, we're applying a 132.5% stress. So in this particular case, the client will be able to borrow 245,658. So quite a significant difference. Now, if the higher rate taxpayer only owns 5% of the property and the lower rate taxpayer owns 95% of the property, then we're going to be stressing it down towards the 125 at the pay rate. So the clients can borrow even more. So we've got an affordability calculator on our website where you can input the figures. It is subject, HMRC are quite hot on this, so we do have to, if it's a 95% ownership in the lower rate taxpayer's name, then we do have to have some evidence of that and confirmation that the rental income is going to be apportioned accordingly. But that's standard HMRC stuff. But what it means is the client can get more bang for their buck, which has been quite useful for us this year, where rates have been high and not a lot of deals have worked. So the deals that have worked have been able to take advantage of our blended ICR. So that bear that in mind. If the client doesn't qualify for a top slicing deal with one of the lenders that offer it, because maybe they've got a large number of properties, whatever the reason, we can offer that on any number of with any number of properties in the background.
Andy, can I just pop in for a minute? In terms of before we move to complex structures, we've got a question. We do polls, as you probably know, and I think one of the polls that we wanted to ask was around how difficult, is you finding it difficult from a broker perspective. So can I just run that poll to just capture the thinking at that point? Is that all right?
Please do. Yes.
So, ladies and gents, could you possibly just have a look at the poll? Hopefully everybody can see that. Yeah, we've got answers coming in already. So the question, are you seeing more inquiries for large HMOs and multi-unit? Oh, that's the wrong question. Is it? I think I put the wrong question up. But there you go.
Been reordered, Jonathan.
Sorry?
I think they may have been reordered, Jonathan.
They possibly have, yeah. But anyway, let's talk about HMOs in a minute. But interesting, that's thank you for that, everybody. That's an interesting, really tight split. And I'll just share that.
So so about just over half are seeing more inquiries for HMOs and multi-units. We've anecdotally this year we've had a lot more inquiries for higher yielding properties. So HMOs and multi-units would fall into that bracket. And what we've been seeing is more professional landlords are more interested in HMOs and multi-units simply because of the higher yield. So Where a portfolio landlord has got a whole range of properties, we've also seen landlords converting properties into HMOs where they can obtain a license. Yeah, and I think that all they need to do is the maths, isn't it? Really, how much am I going to get by letting out a property on a family let basis, and how much rent am I likely to generate if I'm able to let it out as an HMO? So what we found that larger HMOs and multi-units have become more popular on a purchase basis for the same reason. As other areas have, which I'll come on to. To be able to offer an investment valuation on the larger HMO range and multi-unit range is a change from when we launched lending a couple of years ago, and that's been a real positive benefit to us. And we are seeing, we have been seeing a lot more cases that fit into that mould. But moving on to limited company, because I think this is also an area where it's become much more popular for obvious reasons, and many lenders are offering limited company lending. So we're one of those lenders that we say we offer complex buy-to-let solutions, and one of the sort of areas that we're very clear on, and we see quite a lot of inquiries is with not unusual, but out of the ordinary limited company structures. So for example, a typical scenario that a landlord might have is that they decide to incorporate simply to take advantage of taxation benefits or advantages over not doing so, and they incorporate as a limited company, and they're an SPV, nice and simple. So that's been around for a long time. But where you've got a scenario as in on the screen there, we've got an SPV that actually is a subsidiary of two other companies each with a 50% shareholding. As long as we've got a maximum of 4 directors on the application, as long as that can be done, and we're seeing quite a lot of inquiries on this basis, because we're quite happy to lend where the limited company is a little bit more complex. The one in the middle is an SPV that may be a subsidiary of a trading company, which is probably the sort of the more common limited company when limited company became very popular after the taxation changes. But the one on the right there is becoming more and more commonplace as well, where you've got an SPV where an individual shareholder has 50% and the other 50% is owned by another company. So these kind of structures are becoming more and more commonplace for a variety of reasons, and we're happily lend on all of those scenarios. As I mentioned, as long as there's a maximum of 4 directors on the application, we can ignore minor shareholdings. So if it's 19% or less, then we can ignore them, as long as the directors and shareholders that own 75% or more of the company are on the application. So if you've got a complex limited company structure, and to be fair, they're fairly simple, those ones there. There are more complex structures that you might come across. As long as we've got the ultimate beneficial owner, as long as we've got four directors that own 75% or more of the group structure on the application, then we're good to go. So we're seeing a lot more of these kind of complex structures coming through now. The next thing I wanted to talk about, because we talked about HMOs giving a higher yield generally, the other area that gives a landlord a higher yield, which is what many landlords are looking for right now, is to be able to let their property out on a short-term let basis. Now, short-term let doesn't just mean holiday home. it can be for other things, as I'll go on to. So with short-term lets, it is our CHL2 range of products. It can be an experienced or a first-time landlord. And we're quite happy on holiday lets. So, for example, I can't put this in writing, Airbnb. It's because their brand is copyrighted, not for any other onerous reason. So holiday lets is fine. But the majority of cases we're seeing are for serviced apartments. So big city apartments where the landlord wants to let them out maybe 2, 3, 4, 5 nights at a time. And the client comes, goes, might have a void. Landlord then gets someone else in there. So the amount of money that can be generated, or the revenue that can be generated on serviced apartments in bigger cities is phenomenal compared to the same flat that's let out on an AST. So we're seeing quite a lot of kind of business. Now we will also lend on a short-term let basis on HMOs and multi-unit blocks as well. On a case-by-case basis. So yes, we will, but we need to have a good look at the case first. So talk to us or approach us via Notify if you've got that kind of scenario. Remortgages on holiday, on short-term lets, the same as the rest of our range. We're quite happy for remortgaging for capital raising, for example, to raise a deposit to put down on another buy-to-let, for many purposes. Remortgages are equally as popular on our short-term letting product as on our the rest of our range. Short-term lets are available to individuals, limited companies, including LLPs, trading companies. The important thing to bear in mind, though, is we're assessing the rental income as if it was going to be let out as an AST. So this does preclude the little cottage down in Cornwall where someone reckons they're going to get £2,000 a week. We're not going to be going on the £2,000 a week, even if they can confirm that that's been let out across the majority of the year. We're going to be going on the AST rental. So that's the key to this, and that's why serviced apartments tend to be the type of property that we're lending on in more instances than the lovely little cottage down in Polperro or somewhere similar. The property therefore must be suitable for letting on an AST basis, and there must be demand equally as well from owner occupiers and investors. So it's not a holiday let product per se, it's a short-term let product that can be utilized for holiday lets in those scenarios. Once again, I think this is a little bit of a quirk in our product range insofar as we don't need experience. I had a conversation with a commercial broker last week who said, I don't know if you're going to do this. My clients don't have a buy-to-let property at the moment. They want to utilize your short-term let product. No problem whatsoever. It can be used for first-time landlords. So moving on to our refurbishment range, no need to bridge, no need to switch. So most refurbishment products require a client to bridge, carry out the work. Once it's completed, flip it to a term mortgage. Ours is a little bit different insofar as the client goes straight into a term mortgage at the outset. They do the work. We then release the monies by way of a retention. So it's a retention term mortgage, effectively. 3 strands to it: light refurb, which is the most popular; EPC improvement, which will probably be a little less popular now that landlords don't have to bring their property up to a C or above for the time being, or maybe in perpetuity, and cosmetic improvement. And basically, the refurbishment range covers off non-structural work. So light refurb, which is where we see the vast majority of our business. Non-structural modernisation works, which can be signed off under the competent person regime without the need for building controls. So it's not heavy refurb product. But if you've got a client that wants to buy or let out a property, refurbish a property that is not ready to rent at the moment, so it's not in a lettable condition, this product may be one that you might want to consider. The EPC improvement is basically just that. It's where the client is looking to raise the EPC from maybe a D to a C or a B now, just to make it more marketable rather than to adhere to the formally proposed standards. And a cosmetic improvement is a bit of minor painting and decorating, flooring, fittings, minor repairs. So the light refurb and EPC improvement, the property does not have to be lettable at the point of the initial mortgage advance, but it does have to have a minimum EPC rating of E. So that's an improvement that we're looking at making next year into 2024. A planned improvement is to get rid of that minimum E. Yeah, so watch this space on that one. Basically what we'll do is 75% maximum LTV pre-works and post-works. So the client indicates to us what works are going to be done, the value before and after effectively. The valuer goes out, confirms that, and when the work's done, the valuer does a re-inspection to confirm it's been done to the required standards. We release the retention. Available to all borrowers, so individuals, limited companies, trading companies, LLPs, and so on. The one item on here that we can't do with a refurb product is apply it to our large HMO range. So it is available on smaller HMOs up to 6 units, but not on larger in excess of 6 units. Here's a comparison of what you can do and what you can't do on each of those product types. So light refurb, you can do everything from replace the floor coverings to convert C3 dwelling to a C4 HMO, replacement bathroom, kitchens, and so on. Nothing load bearing, so a roof extension is fine as long as it doesn't change the roof line. So fitting of a dormer, for example, is not acceptable on this product. So that's classed as structural improvements. Will we have a heavy refurbishment product in the future? Watch this space. Don't at the moment. It's light refurb, EPC improvement, cosmetic improvement. But you can find that information on our website. What can be done, what can't be done. So in summary, we've got quite a wide-ranging offering when it comes to buy-to-let. So just a few things that I haven't mentioned that are now shown on the screen. First-time landlords, portfolio landlords. It doesn't matter how many properties they've got in the background. So whether a portfolio landlord's got 4 already or 400, that's fine, and the blended ICR can be applied on what they're bringing to us if necessary. If they're still buying properties in their individual name. We'll lend on student lets as well as standard lets. The question was asked about housing association lets, so that's down there on the bottom. If local authority leases and ex-local authority leases. And I think that where we've got complex limited company structures, the third line down, we show intercompany loan deposits and directors' loans. Of course, that's all acceptable because that's how you get the money into a limited company by way of a director's loan or an intercompany loan in the case of a more complex structure. What else? What else is there that I haven't mentioned? Studio flats, 30 square meters, but talk to us or approach us on Notify if it's slightly smaller. So it's one of those where, yeah, we can look at an exception on a smaller unit, subject to that, as always, valuers' comments. Does this property make sense? So if you've got any questions, please get them in.
Andy, there's loads of questions. The stacks. So do you want to just take down the slides? And I'm just, instead of keep interrupting you, I wanted to try and leave them till the end. So forgive me, you may have answered some of these as you went along, but I didn't. But I'm literally going to go through them. I think we've got 13 questions. So that is really good, because that means you've got a really engaged audience.
Yes.
So back to the first point about CL1 and CL2 in terms of housing associations. Would they be one or two?
One. That could be a one. Yeah.
Okay. Simple answer.
Yeah. So both is the answer. Sorry. So yeah. So it can be a one, can be a two, depending on the other parts of the deal. Okay.
So anonymous question here. Would you consider a remortgage of a portfolio of buy-to-let properties in an SPV on a single mortgage application with a single mortgage repayment?
No, unfortunately not. So each property would be subject to its own account. So when an intermediary is applying on behalf of a portfolio client, we have the facility, once they've applied for their first one, it can be copied over to the second and subsequent properties. So you don't have to rekey all the information, other than, of course, the property information, because that's going to be different on each one. So it would be separate mortgage applications and separate mortgage payments.
Okay, thank you. Again, in the order they came in. So how do you calculate affordability on short-term and holiday lets? Is it an average, high, low, medium, or just AST? I think you answered that one actually, didn't you?
Yeah. So yeah, I did. That's the AST. So we basically, it's a standard buy-to-let product, really, where we allow it to be used as a holiday let. But yeah, the affordability is going to be based on AST income, as indicated by the valuer. Excellent.
Thank you for the question. And then a question here from Andy Virgo. Obviously, Andy knows you. Says hello.
Hello, Andy.
Do trading companies need property-related SIC codes, as well as the codes that relate to the specific business and trade or trading?
No.
Is that simple? No. Yeah. Okay. Moving on, Andy.
You know me, Andy. I try to get to the point quickly.
Yeah. Okay. No. Gifted equity. Do you accept that as a deposit?
Only from close family members.
What do you define as close family?
Blood, parents, siblings, children.
Uncles and aunts?
You need to talk to us on those, or use Notify.
Yeah. Okay. Okay. Nice one. Yeah, I think there are examples of, I think, that we would normally say, but okay. Excellent. Anonymous question. Do you accept the price of the property, brackets, after the refurb, if within 6 months, or is it based on the purchase price?
Both. So we're 75% of the initial valuation, and then 75% of the post-works value.
Okay, hopefully that is clear enough and clarifies. Question from Andy Watterson. How are CHL with first-time buyers, first-time landlords? Do they need to own their own property and maybe never have? I think you answered that one again.
Well, I'm not sure I did, Jonathan, actually. We will allow first-time landlords, but they must have owned a property in the UK for at least a year.
Okay. Okay, not necessarily consecutive year.
Yeah, it has to be now at point of
Okay.
application. They have to be a UK homeowner and have been so at least a year.
Okay.
Yeah.
Okay. That's hopefully that answers the question. The next question is exactly the same question, so we've just answered that one. Just bear with me. So Gemma Fernandez, on the refurbishment product, would you consider a hybrid 4 times flat above 2 retail units under the same title?
2 flats, so a multi-unit block effectively. But is the retail unit separate?
Well, it says above. She says it's a hybrid. It's 4 flats above 2 retail units.
In one on one title?
Yeah.
Technically, no. But as always, we're prepared to, view a case favourably if it stacks up. So
Okay.
get in touch with us via Notify.
Yeah, I think Gemma, you were the person that raised the question about the high end refurbs as well, weren't you? So whether I'm just making the link there that there may be justifiable reason to stretch the criteria to that. Yeah, use Notify if you can. Anonymous, and I've got some more, plenty of time, but I've still got 8 questions, Andy, so that's good news. Anonymous, is this purely for buy to let, or is it available for residential purposes as well?
Just buy to let.
Just buy to let. Okay, just buy to let. Simple answer. Do you lend to properties where the tenant is a care provider as a limited company? So care providers, I know that's an area.
So in other words, vulnerable tenants?
No, I suggest it means that the care provider is a limited company and owns the property.
If they're going to be using it to house vulnerable tenants, then no. If they're going to be using it as a trading company to let out on the open market, then no reason why not. Yeah.
I mean, from the question, it's difficult because it's an anonymous question.
Yeah.
But I would guess that the question is more around the limited company care provider owns the property and lets it accordingly, and therefore probably to the no. But as you will say, come back to us. Rakesh, question for you, big one. How do you stress existing portfolios?
We would stress them at 5% still, and at the relevant rate, depending on whether they are a limited company, which would be 125. A higher rate taxpayer would be 140, or a lower rate taxpayer would be 125. Yeah. Okay. Hopefully that answers your question, Rakesh. Gemma's just come back to me, actually. The retail units that we talked about with the 4 attached flats, they're not separate. So it looks to me like a unit. It's a double unit with 4 flats. Right. Oh, I see. So it's the multi-unit block must be really in a standalone, rather than above a commercial. Yeah, I'm afraid.
Okay. Sunny question from Sunny Sandu. Do you accept buy-to-let applications where a holding company provides a loan to the SPV for the purchase?
Absolutely. Yes.
That's again, I think we covered that one off, didn't we? So,
yes.
Ilhami, I think it's a question from Ilhami. Speaker referred to semi-commercial properties may be considered for remortgages.
Not currently. Semi-commercial, part commercial, or mixed use, depending on which way you want to describe them, is on the agenda for us. That is an area that we are seriously considering. But again, watch this space. So not currently, I'm afraid.
quite a lot of watch this space, which is really encouraging, because I know that you've made massive strides to change and react to the market. And from the conversations that you and I have, Andy, I know you can't say a lot of it, but there's an awful lot to come. David McDonald, I may be able to answer your question. I don't think Scotland's on the radar today, but what are the thoughts?
Yeah, I mean, as you're probably aware, I mean, it's Scotland requires a completely different set of legal terms, so it isn't on the agenda at the moment, I'm afraid.
Yeah,
and then the same answer for Northern Ireland. So it is just England and Wales. So I'm afraid to say no plans.
okay, sorry about that point. There are lenders, obviously, that we can consider that. So
Sure.
use Knowledge Bank to work those out. Ilhami has asked another question around flats, commercial properties. What kind of trades are your bag in terms of ground floor accommodation? So what kind of trades do you?
Well, it's probably easier to indicate what we don't want to lend when the flat is above a restaurant, fast food, noisy, smelly, combustible is the adage which holds true here. So noisy, perhaps antisocial behaviour, or a plant that creates a lot of noise by virtue of what it does. Smelly, that would be that would fall into the realms of the food industry, but also nightclubs, pubs. We wouldn't lend above within criteria. But as always, we are prepared to look outside criteria at cases where the loan to value is low, and the property is a good quality property.
Yeah.
So we have lent on flats above restaurants, although our criteria says no.
Yeah. Again, I think that's becoming a part of this, isn't it, Andy? We're seeing lenders be used more now on the notify service, and I think what we're doing is we're seeing examples of lenders really being flexible, but obviously within reason, and there is that balance, I appreciate, between publicly declared criteria and actually a really good lens. So it's still there, that opportunity to flex where possible. So relationship is really important.
Yes.
I've got one more question, and I'm going to just read it as it comes. I think this one again is an anonymous attendee, but this is the kind of question that would ideally be taken through the notified system, I think, because there's lots of criteria bits that we can check on. Would you consider, and I'll ask the whole question if that's okay.
Yes, sure.
Would you consider a foreign national with a business visa? The applicant is a director of a limited company and already a homeowner with a residential mortgage and a buy-to-let in a limited company. The applicant is looking to purchase another buy-to-let under the limited company name, in the limited company name. The applicant has been in the country for the past 8 years, and this is his last renewal before he is offered indemnite, is that right?
Yeah, indefinite leave to remain.
Oh, sorry, indefinite.
Yeah. Long question, short answer, I'm afraid, and that is no. We do require foreign nationals to have the right to reside indefinitely in the UK. So this particular client isn't quite there yet for us, I'm afraid. But there are some lenders that will. So use Knowledge Bank and you'll find out who they are.
yeah, absolutely. I've got one more question, final question. Do you allow the transfer of a residential home into an SPV to become a buy-to-let? If so, can the client use gifted equity as the residential homeowner and the director of the SPV are the same person? And then it says, I believe it's not a consumer buy-to-let as it's been purchased by an SPV. So again, if you could...
Yeah, so strictly speaking, if it's a limited company purchase, it's not a consumer buy-to-let. However, whilst we're an unregulated lender, so we're not regulated by the PRA, we do adhere to the spirit of the consumer buy-to-let rules, of course, and that's a bit of a grey area. So if the property has been lived in by the person that will be owning it, whether they're a limited company or an individual, our answer is we would have to view that as a consumer buy-to-let to adhere to the spirit of the regulations.
Yeah, and I think that's fair. That is fair enough, and that's a very, clear answer, I think, for that individual. So hopefully that's 22 questions. I'm not sure whether that's a record actually of questions.
Oh, no.
So that says to us that I think you've been extremely engaging.
Thank you.
If there are no other questions for Andy, I'm happy to draw it to a close. Is there anything else that you want to add, Andy, before we kind of sign off?
Well, I think, yeah, if you haven't spoken to anyone from CHL before, then please register with us, or get in touch with me. I'm not sure if you share my email address and mobile number, but I'm on our website, obviously. So get in touch with me or any one of our BDMs in the area that you operate in, just to sort of establish a bit of a relationship. And I think in terms of what else you need to be aware of about us is something that I mentioned right at the start. We're one of the few lenders, one of three lenders that's lending today in the buy-to-let market that was there right at the very beginning when buy-to-let actually became a thing back in the mid-90s. So there's lots of experience and lots of knowledge at CHL. Me personally, I was also there right at the beginning as well. So please don't hesitate to have a conversation with us, as well as deal with us via mediums like Knowledge Bank and Notify.
Andy, I think you've absolutely nailed it, to be honest. I think you've certainly, I think you've proven that you're right, that longevity, your experience and your approach. And I think on a personal level, I think you've done you're a credit to CHL, and I would thank you for your openness. Of course, I think the session's been clear. I think you've been honest around where you can flex and where you can't. And I know this comes at a time where there's been significant change for you, because we were going to do this a few months ago, weren't we? And you said, no, we need to wait to do it. So
thank you for being accommodating.
Lots of watch this space. We would encourage you to reach out to Andy and the team. And if there's any other questions, I'm sure we can follow them up. But on behalf of Knowledge Bank, Andy, I'd like to say thank you, and all the attendees as well. And thanks for attending. The CPD certificates will be on the way. And also, I just remind you around the free trial if you're not using Knowledge Bank just yet. But apart from that, I'm going to wish everybody a great day, and we'll see you again soon.
Yeah, thanks everyone for attending. It's been great.
Cheers. Thank you.
Bye now. Bye.
Bye.